Welcome to The Drawdown, a podcast by Cherry Beckert's private equity practice. In each episode, we explore the latest trends in the private equity sector, as well as challenges and opportunities in the ever-changing investment environment.
Hello and welcome to The Drawdown. In this episode, we'll be diving into a topic that has been gaining traction recently: the transferability of energy tax credits and how they are impacting the private equity industry. As the world becomes increasingly focused on sustainability and renewable energy, transferable energy credits have emerged as a valuable asset for private equity firms to invest in. I am Chris Truitt, Cherry Beckert Partner and Transaction Tax Practice Leader. Join us as we speak with industry experts and explore the opportunities and challenges of investing in energy tax credits. Let's have our speakers introduce themselves.
Hi, I'm Marty Kerman. I am the head of our Tax Credits and Incentives Advisory Group, and I'm joined by three of my other colleagues who will introduce themselves now.
Hello, everyone. My name is Will Billups. I'm a tax partner with Cherry Beckert in the Nashville office, also the firm's leader for tax provision services. Thank you for joining us today.
Hey, everyone. This is Tim Doran. Great to be talking on this topic today. I'm a director in our TCIA practice.
I'm David Momani. I'm a manager in our tax credit investment advisory practice, and I have the specific focus on energy credits.
Okay, great. Thank you, guys. Okay, so let's set the stage today with a little bit of background, specifically around the Inflation Reduction Act and how transformative that was. Tim Doran, if you wouldn't mind taking us through a little bit of history there with the IRA and the opportunities it now provides to our clients.
Absolutely. Thanks, Marty. Yeah, this is it's an interesting space because there were a lot of different incentives available for folks taking advantage of clean energy asset acquisition and looking to have the federal government help them with that. And that went on for many years. And David and I have worked in that space for many years. But the Inflation Reduction Act kind of turned it on its head. A lot of people are familiar with kind of the expansion of the technologies that now get federal energy credits, the increase in the amount of money you get. But what we're going to talk about today is kind of an entirely new regime for how these types of credits can be funded. We haven't seen anything on the federal level like this before. This is an entirely new concept for how taxpayers can go about saving themselves some money on their own federal taxes, while also investing kind of indirectly in clean energy type technologies. So the IRA really, when we say transformative, it really did change the entire way we think about federal taxes.
So now, Will, it seems if our clients like owned by private equity certainly have an appetite for purchasing credits. You work a lot in that space. I was wondering if you could go through a little bit and explain why they are such good candidates for purchase of these credits and how you've seen that marketplace. And then we'll talk a little bit with David about how he's seeing the marketplace evolve.
Thank you, Marty. This is absolutely the biggest tax planning opportunity that we have seen in a very long time. This provides an avenue for private equity to be able to effectively manage their cash and reduce their effective tax rate for their portfolio companies. The IRS did come out and noted that these should be considered passive credits. We'll cover that a little bit more later, I'm sure, as you get into the in-depth piece. That provides some limitations for individuals who have to have passive income. But that doesn't apply for the C corporations. So what we've seen in this space is we've been a leader going to market related to the reduction of cash tax payments and effectively managing tax rate. Is every PE that we've been involved with absolutely sees this as a no-brainer opportunity and wants to know more. And there's more operationally than just the portfolio companies. There's some potential application at the fund level and above.
Okay, that's excellent. So now, David, you've been working with a number of taxpayers who are looking to purchase credits. You're working a lot with some of Will's clients right now, actually. Maybe I think for the benefit of the listeners, if you could discuss a bit the current status of the transfer market, the availability of credits, and kind of how you spend your time on a typical transaction.
Thanks, Marty. So right now, what we've seen is pretty much any credits that were 2023. So to be a 2023 credit, that means the credit was generated in 2023 when the asset was placed in service. The inventory there is pretty much non-existent at this point. Most of those have been accounted for. We have seen a few still come on late in the year, but with the 10/15 filing deadline kind of around the corner, most of those deals have pretty much been completed. We are seeing a healthy amount of 2024 inventory across the several marketplaces that we work with. And I kind of expect, similar to this year, we're going to see credits come online throughout the year in terms of just some people that aren't ahead of this curve and kind of add their credits later, probably in like the first 2 quarters of 2025. I would assume there'll probably be more credits, a larger influx then. And there's already some 2025 credits being listed. So it's a healthy amount of inventory for the 2024 and 2025 at this point. The way that I typically spend my time on these transactions is I work with clients in kind of sourcing a credit that makes sense for them in terms of the amount they're looking for and kind of within that price range that they're looking to trade at. So I spent a lot of time working with the various markets and kind of seeing what their inventory looks like and kind of what the terms each seller has for the credits to see kind of which ones would be good fits for our clients. Once I'm able to identify kind of a credit that might be a good fit, that's typically when I'll get into kind of the due diligence side of the transaction, where we're reviewing all the documentation provided by the seller to see if there's anything, make sure that the credit is above board and there's nothing that would cause us to be concerned potentially about purchasing this credit.
That's great. And just to clarify, what are you seeing from a pricing perspective right now? Is it still approximately in the range of about 85 to 90 cents on the dollar?
Yeah, I mean, there's a lot of mitigating factors determining kind of what the credit price is. So for entities looking to use this as to further estimated tax payments in terms of wanting to guarantee they have a credit early in the year so they don't have to kind of be risking the end of the year, like hoping they get a credit, we'll see those trade a little bit higher, probably 92 to 93 cents. But the smaller credits kind of are in that 85 cents range at this time.
Yeah, that's great. And then I think for our last topic, really, I want to throw it over to Tim Doran to talk about our due diligence process. This is clearly the most important thing that I think we do as a firm for companies, portfolio companies, et cetera, that are looking to purchase credits. We will analyze the type of credit, the costing, et cetera. But I want Tim to talk a bit about what do we do on our buy side due diligence and what are we on the lookout for?
Yeah, thanks, Marty. You're absolutely right. Buy-side due diligence is crucial, and maybe to kind of walk folks through it that are interested in taking advantage of this opportunity. Give just a touch on the history, a little bit more with the IRA, and then a little bit of the specifics of how these credits work, because I think that will inform listeners as to why it's so important to get an expert to take a look at these things. So before the IRA. I had mentioned that these credits were available to provide an incentive to invest in clean energy. And there were a lot of folks that were buying these assets that didn't have a federal tax liability, but they were big, large institutional players. And so we were talking a lot of dollars, and they worked with their tax advisors, their lawyers and their CPAs, to come up with some very sophisticated tax equity partnership structures in order to allow them to take other players and partners and monetize the credits, even though they didn't have the federal tax liability. Congress was aware of this when they passed the IRA, and part of the purpose and intent of this new transferability scheme was to allow other folks that to enter into this space to transfer credits at a smaller level where previously the transactional cost would have been too high to make it work. And so all of the things that we used to look at from the perspective of due diligence still apply. And so a lot of those are the technical requirements of the code. When did you place the asset into service? When did you begin construction on the asset? What is the technology and whether or not it's qualifying? What about how do you compute the proper amount for the qualification of the credit? And this is all important from the perspective of a buyer because the new code is clear that the transferee, that is the buyer of the credit from the transferor seller, is on the hook if a recapture event occurs. And so there's this provision that after you place the asset into service, there's a 5-year window upon which you can't sell that asset as the owner of the asset, which would in this case be the transferor. If that asset is sold or otherwise disposed of, there's a recapture that occurs pro rata throughout the life of that 5-year window, and the buyer of the credit would be responsible for that. Now, there are a lot of mechanisms that have come in place in the market. There's insurance and there's indemnities that the seller will make, and we think the risk here is ultimately not really that high. However, it's really important that you have an advisor by your side, making sure you're analyzing all of these different risks, walking through what kind of credit you're buying, because there's a whole host of different types of credits out there, and then ultimately making sure that the credit you're purchasing is a qualified credit and is calculated in the right amount.
That's perfect. And thank you so much. And I think what I've seen is, yes, it used to be just institutional investors in the tax equity market. It's still not for the small company. There is still some expense that goes into the due diligence process, but it is opened it up to a large number of taxpayers who can now look at this that couldn't previously. Thank you. With that said, Chris, thank you for inviting us to the drawdown and giving us the opportunity to talk today.
Thanks, Marty. Thank you to our listeners for taking the time to join the Cherry Beckert Private Equity Podcast, and thank you to our speakers for joining to discuss the topic. If you have any further questions about the benefits and transferability of energy tax credits, please reach out to any of our speakers today. Thank you again for joining us.
Thank you for listening to The Drawdown, Cherry Beckert's Private Equity Podcast. The views presented by our guests do not necessarily represent the views of their respective firms. For more information on how Cherry Beckert serves as a guide forward to private equity funds and their portfolio companies through accounting, tax, and advisory services, please visit cbh.com.